Hello, and welcome to the second episode of the Special Situations Report podcast by Inside Arbitrage, covering the most intriguing event driven activity over the past week. In this podcast, we'll dive into the latest M&A activity, upcoming spin offs, significant buybacks, unique insider buying, activist campaigns, and more. Today, we're bringing this podcast to you from the beautiful San Francisco Bay Area, and we'll be covering the largest M&A deals from the last week. We'll also cover Bill Ackman's offer for Howard Hughes, a fascinating insider purchase at a biotech company that treats narcolepsy, and additional developments in the special situations world.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
So, to get started, last week we said that the US Steel, Nippon Steel deal was likely dead because the Biden administration blocked the deal. But we were a little premature in saying that because Cleveland Cliffs indicated that they were still interested in a potential deal with US Steel. We talked about it last week where we mentioned that before the US Steel Nippon Steel deal was announced, there were multiple bidders for US Steel, and Cleveland Cliffs was one of them. So, not quite dead, and they extended the outside date of the deal to June. So, a few more months before we know how all of it plays out.
Yeah, and a couple other big mergers announced this week, starting off with H&E Equipment Services, which is to be acquired by United Rentals in a $4.8 billion deal. United Rentals is set to pause share repurchases, but they will continue paying dividends in order to fund this deal. This is structured as a tender offer, and the deal is expected to close by January 28th, so it's a pretty short time frame.
Yeah, so we saw two multi-billion dollar deals last week, and some of this was probably just the impact of the JP Morgan healthcare conference in San Francisco. The other big deal that was announced last week was Johnson & Johnson acquiring Intracellular Therapies, a company that focuses on neurological diseases like bipolar disorder. The size of the deal was quite significant. It was a $14.6 billion all-cash deal for $132 per share with no CBRs involved.
In addition to announced M&A activity, we also track deals in the works, or potential or developing M&A. And it was in this deals in the works space that we found the most fascinating special situation this week, the potential acquisition of Howard Hughes by the famous investor Bill Ackman. Howard Hughes is a familiar name to us here at Inside Arbitrage, and to anyone who's been keeping up with our content for some time. The company is a real estate development company, but isn't structured as a REIT. It typically builds master plan communities, and as someone who's grown up in an MPC all my life, I have to say I absolutely love the setup of everything being so accessible and close to my home. In addition to creating MPCs, Howard Hughes also sells condos in Hawaii. We've been keeping an eye on Howard Hughes since November 2022, which is when Bill Ackman's Pershing Square Capital began rapidly adding to their stake in the company. Over the years, Howard Hughes has turned into what I like to call a special situations bonanza, where it seems like there's a new event-driven development at every twist and turn.
So we've written about Howard Hughes 3 times over the last 13 months. Howard Hughes was always trading at a big discount to NAV because of an underperforming division called the Seaport Entertainment Division. They decided to spin off that division a few months ago, and this division consisted of waterfront property, the Seaport neighborhood in New York. It also had, for some strange reason, a baseball park as well as a baseball team, and then a certain stake in some restaurants. So this wasn't a core division, if you will, of Howard Hughes, and spinning it off unlocked value in Howard Hughes. But the company continues to trade at a big discount to its estimated net asset value, which the company conservatively put at about $118 the last time it reported results. Last August, after the Seaport spinoff, Bill Ackman at Pershing Square filed an amended 13D, indicating that they wanted to explore an acquisition of Howard Hughes. And at that time, there was no formal offer and there were no details revealed. But at this point, we've now seen that they want to acquire the company for $85 per share in either a cash or stock deal. The stock is trading at about $76 right now, and so it's quite a bit of a discount to the $85 offer that Howard Hughes has received from Bill Ackman. What we are likely to see here is the minority shareholders, well, which actually control 62% of the company. They're not quite the minority shareholders, but Bill Ackman and Pershing Square, they control 38% of the company. I feel that they will have to negotiate with the other shareholders and quite likely bump up the acquisition price somewhere in the $90 to $100 range, or potentially even higher, to get the necessary shareholder votes they need for this deal. So it's trading at 76 right now. If the final deal is negotiated at $100, there is still some upside to this pre-merger situation. Although, because of the cash or stock part of the deal, you're likely to see it continue to trade at a discount even after the final transaction price is announced.
Another potential deal brought up this week was the merger of the AI service Perplexity with the social media giant TikTok. As many know, TikTok was set to be banned in the US this weekend due to privacy and safety concerns regarding its parent company, ByteDance's, ties to China. However, the probability of this deal actually going through seems quite low. TikTok has already been brought back into service in the US after President Trump granted the company a 90-day extension to avoid the ban. We'll see if more suitors emerge after those 90 days to acquire the company and keep its operations running, but if not, after those 90 days, we might truly see the end of TikTok.
Fascinating situation overall. We don't really know who is going to benefit from this ban. It could be Elon Musk's X, it could be Instagram and Mark Zuckerberg, but it's too early to see how this whole situation plays out. Switching gears a little bit, let's talk a little bit about insider transactions. A company that really caught attention last week was Easterly Government Properties. The CEO of the company purchased 10,000 shares, and the ticker of the company is DEA. Considering the name of the company has government in it and the ticker is DEA, I was curious to see if the Drug Enforcement Agency was one of its clients. When I pulled up this company, I noticed that not only was the DEA a client, their biggest clients included the VA, the FBI, and many other government agencies. This is a $1.2 billion REIT, and with many of these government agencies as its tenants, the occupancy rate is unusually high at almost 98%. We will likely expand on this idea in our next Yield Guru update at the start of February.
Yeah, so a lot of these points about Easterly government properties, including the fact that it has a single tenant, the government, and the fact that they have incredibly high occupancy rates, reminds me of another REIT, that being Postal Realty Trust.
Yeah, Postal Realty Trust is a fascinating REIT that we came across because of insider buying by the CEO as well. I got a chance to meet with multiple members of the management team when they were in San Francisco. This company focuses on leasing space to the post office. So it has a single tenant, a single customer, which is the US Postal Service. And their occupancy rate is actually even higher than that of Easterly Government Properties. And the occupancy rate is 99%, which is highly unusual for a REIT. After I took a look at the company and wrote about it, I was waiting for it to drop to the low $13 levels, which is where usually I see the CEO step in and buy stock. And the reason I usually wait for the low $13 levels is because at that point in time, the dividend yield on this REIT is a little higher than 7%, which is exactly where the stock is trading right now. Switching over to a different insider purchase, which just completely caught our attention, was Avadel Pharmaceuticals. This is a biotech company that created a drug that treats narcolepsy, which is excessive daytime sleepiness. And what we saw that really was fascinating was the financials, where we saw this inflection point with revenue growing quarter over quarter, and then earnings, or rather the losses, declining over time to a point where it looks like the company is ready to inflect higher and start posting positive earnings instead. The reason this is happening is the company received FDA approval for its drug to treat narcolepsy in May of 2023, And they decided to go it on their own instead of merging with a large pharmaceutical company and commercialize the drug. And what you see in the chart is the company's efforts to commercialize this drug and gain market share against competitors.
Speaking of competitors, Avadel is not alone in creating a drug to treat narcolepsy. Well before Avadel received approval under the Orphan Drug Act to treat narcolepsy with their drug, the biotech giant Jazz Pharmaceuticals had also created a very similar drug to treat the same condition. Both drugs have a sodium oxybate based formulation, and according to a lawsuit filed by Jazz Pharmaceuticals against the FDA, both drugs were essentially the same. However, the key difference lies in the drug's dosage. Avadel's drug is single dose, meaning patients can just take the medication and head to bed for the night. Jazz's drug, on the other hand, is split dose, and that means patients must wake up in the middle of the night to take their second dose. This dosage difference is what the FDA used to deem Avadel's drug to be clinically superior, and thus Avadel was allowed to enter the narcolepsy treatment market and has been steadily growing its market share. So upon first glance, everything looks great for Avadel. Everything seems to be stacked in their favor, but considering the stock is down nearly 50% over the last year, that raises a couple questions.
Yeah, so it was interesting to see that the chief commercialization officer left the company recently. And I think we can pull it up here and look at our events. Yeah, Richard Kim left. His effective departure date is the end of 2024. And that tells us that maybe things are not going as well as you would expect them to be. This is a company that is gaining market share from Jazz, but isn't growing the overall market, if you will. The other drug that they have in their pipeline, which is in phase 3 trials, is called Revitalize. But it's essentially seems to be the same product applied to a different kind of sleep disorder. So that explains why the stock is down almost 50% over the last year. And you start seeing all this insider buying that we saw in December and then more recently last week by two directors as well.
Let's transition over to C-suite transitions, starting off with Gen Restaurant Group. Gen Restaurant Group, better known as Gen Korean BBQ, is an American chain of all-you-can-eat Korean barbecue, and the company recently saw its co-CEO, Jay Chang, leave. When we first saw the notification that Gen's co-CEO was leaving, we were extremely surprised, especially considering that we saw an insider purchase at the company just a few weeks ago by none other than the co-CEO.
Yeah, but that was the other co-CEO, not the person who's actually leaving, who we saw buy shares on the open market, and his name was David Kim. What's fascinating about David Kim was the Form 4 filing, and I'm going to pull it up here. He made this purchase indirectly through an entity called Throughput Call Forever. Anybody who trades options knows what this might mean. And so that is what caught my attention. But then I looked at this CEO some more and his background, and it was interesting to see that he used to be the CEO of the Mexican food chain called Baja Fresh. And at one point, he was also on an episode of the reality TV show Big Boss.
So, a lot of interesting activity going on at Gen Restaurant Group. But speaking of C-suite transitions as a whole, we were quite surprised to find out that there were 43 sudden departures this month alone. So, what is a sudden departure? It's when we see an executive member suddenly resign with less than 1 month between the announcement date and the actual effective resignation date.
Yeah, I would have thought it is super unusual to have 43 sudden departures among CEOs, CFOs, chief legal officers, and so on and so forth. But when I looked at our data and I went and looked at the prior month, there were 37 sudden departures that month. And I looked back a month before that, and that was 59 sudden departures. So maybe it was just the holiday season, and C suite executives decided they wanted to do something different with their lives. Or maybe it was planning for the new year, and the company decided it was time to make a change at the C suite level. So this is highly unusual, but I'm looking forward to diving into our data some more to understand if this level of sudden departures is a norm around the end of the year or it's something completely unusual. One area that is a key concern is either legal or accounting folks leaving the company with very short notice to the company. Sometimes it's single day departure, so you get to see the SEC filing and the executive departs on the same day. And so when we see that with like general counsels, chief legal officers, for example, a chief accounting officer or a CFO, that could be a potential negative signal if you own the company.
So we actually saw a couple examples of that cause for concern this week, starting off with First Solar's chief accounting officer suddenly departing and their corporate controller being internally promoted. Coca-Cola CFO is also resigning, effective April, and Warner Brothers has hired American Airlines chief legal officer. Big Bear AI CEO also immediately departed, yet there's been a new CEO appointed, and he has connections to the Trump administration, which led to the company's stock rising by over 22% in a single day. And that wraps up some of the most interesting C-suite transitions of this week.
So a company going up 22% in a single day would sound quite amazing unless you experience what we did this weekend with the Trump meme coin, which went up several thousand% and potentially made Trump billions of dollars from the launch of that meme coin. Switching over to special dividends, we noticed a very large special dividend that was announced last week. This was by the Chinese video streaming company Douyu, which announced a $9 per share special dividend at a time when the stock was just trading at $12. As you would expect, the stock rose to almost $15 a share after this announcement. The reason we're bringing this up is because most people who focus on M&A and merger arbitrage remember that Douyu and its competitor Huya were trying to merge, but that merger was blocked by the Chinese government.
So, dividends are a great way to return value to shareholders, but another more common way of returning value to shareholders is through share repurchases or buybacks, which we saw two very massive buybacks this week. The first one we'll discuss is Royalty Pharma, which announced a $3 billion buyback, which was about 22% of the company's market cap at announcement. So it's a very massive buyback, almost about 1/4 of the company's market cap. And that resulted in a nearly 12.5% jump in stock price after the said buyback was announced. Royalty Pharma is a very unique business. It collects royalties on drug development, but in the sense that it does this by providing funding to late-stage clinical trials and then collecting royalties on the drug once it has been commercialized. It has ties to some pretty big drug franchises, including Gilead's HIV franchise and Vertex's cystic fibrosis franchise.
Royalty Pharma was an interesting company, but the other buyback that caught our attention was a $20 billion buyback by Citigroup, which represents almost 15% of the market cap of the company. Citigroup, as most investors know, wasn't the top company that people think of when they want to invest in banks. Yet the stock has gone up quite a bit. I think it's almost doubled over the last year, which has outperformed even the performance of most other banking stocks. Citigroup used to trade at a big discount to tangible book value, and despite this increase in price over the last year, it continues to trade below tangible book value. And it makes sense that the new CEO that came on board just 2 or 3 years ago is now deciding to buy back stock at an accelerated pace. We're going to wrap up our discussion today by covering a spin-off situation where IAC decided to spin off their stake in Angie. Investors are not too keen on some of the parts situations or companies which are trading at a big discount to NAV because often the value is not realized and the discount to NAV doesn't close. And IAC is a classic example of a company where a lot of people look at the sum of the parts and realize that it's trading at a big discount to those parts. The different parts of IAC include Angie, they have a big stake in the car sharing service Turo, as well as companies like Vimeo they spun out not too long ago.
I will say I have conflicting opinions on IAC personally because I do have a soft spot for the company as it was one of the first companies I wrote about in an Insider Weekends article. At the same time though, I have a bone to pick with IAC because they stopped funding one of my favorite independent comedy platforms, Dropout.tv. But moving back to the business side of things, in addition to the spin-off, Joey Levin, the current CEO of IAC, is no longer going to be the CEO and is stepping down, leaving Barry Diller as executive chairman. However, in the meantime, Joey Levin will be going ahead and joining Warner Brothers' board of directors.
I can imagine that Barry Diller is probably thrilled to be back as CEO of IAC, a company that he founded in 1995 after working at Paramount Pictures as well as Fox. He has created a lot of value at IAC over the last several decades, including spinning off companies like Expedia and Ticketmaster, which then merged with Live Nation. The last spin-off, Match.com as well as Vimeo, haven't done quite as well as prior IAC spin-offs, but hopefully with Angie being its own independent company, it'll get the attention it deserves and will continue to thrive. And IAC can get back to creating value from new investments as well as realizing value from investments like Turo, the car sharing company that it doesn't completely own, but owns a significant stake in.
And that wraps up our second episode of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you might be listening on, and especially share it with your friends. We look forward to seeing you again next week.